The typical diversified portfolio for most investors is just going to be long equities and long bonds. That's going to drive most of the returns. And managed futures are very different. They're really a true absolute return strategy with the hopes of consistently, very consistently, no matter the market regime, to be producing positive returns. And at the same time, managed futures have very low correlations to equities and bonds, and actually can have positive convexity when bonds and equities sell off strongly. So managed futures are kind of a holy grail investment profile for a typical balanced portfolio. And this is why endowments and the biggest institutions have been using these strategies for 5 decades now, and in size.
And it's important to note for many investors out there that with the relaxation of derivatives rules, this asset class is now available and in a very liquid product that can add a tremendous value to your portfolio.
Yeah, and generally a fraction of the cost, right, versus the hedge fund version. Yeah.
With daily liquidity.
Yeah. Yeah. So managed futures funds run a diversified suite of purely quantitative algorithms. These algorithms can be trend following, mean reversion, carry trades, breakout trades, anything you can really generate alpha with systematically is in the mix. And these models can run over daily forward horizons, weekly, monthly, annual. So you're really diversified over the types of signals because of that time horizon diversification. And they're generally run across any asset class that's liquid and easily tradable. And so you just have this little black box that kind of just can go anywhere at any time and just can always try to find positive return sources. And so you can kind of imagine it just slowly finding opportunities, quickly finding opportunities in different places, whether it's being long, short, holding for a day, holding for a month, or whatever the style of trade. And that can really sort of just create this slow and steady absolute return profile that we mentioned earlier. And then simultaneously, since it can go short, that's how you can really create a diversifying convexity payoff versus your long bonds, long equities. And that's how you really bring in that diversifying nature as well.
Managed futures are a very powerful tool that can add a lot of diversification because of the powerful diversification benefits. Something on the order of 10 to 20% in a traditional allocation, we feel is the appropriate sizing. But because of the powerful benefits of diversification, the ability to be long or short, we feel that this is a tremendous addition to a traditional portfolio.
Yeah, it's just such a unique profile, and it can just add. You can kind of look when you run an optimizer and you look at the marginal contribution to return and marginal contribution to risk, and look at these types of statistics. I mean, the amount of benefit in portfolios of 10, 15, 20% slug of managed futures is incredibly significant because it's just so different. That return profile we've described so far is so different than the core equity bond holdings. I mean, you'll see papers out there saying 40, 50% managed futures is going to be optimal in a balanced portfolio. I think a lot of endowments out there will go up to 20, 25%, but they have other things. They have private equity, private real estate. They have other assets to deploy capital in. So that I think limits it a bit, but yeah, I'm with you. I think 20, 30%, you probably start to see some diminishing return in the portfolio benefits once you start getting above 30% of allocation. The risk of inflation in portfolios is obviously been a big 2022 topic. Hasn't been a big topic in a long time. So this is it's a great question for right now. And look, the best inflation hedge for a typical investment portfolio is going to be long commodities, but long commodities can really drag on a typical balanced portfolio for extended periods of time, right? But It's hard to be long commodities just for the inflation and protection side. But if you look at trend following on commodities, and even if you think about it, makes sense, trend following on bonds, and even potentially equities, you can actually get the inflationary protection you want without the drag when you're out of an inflationary regime. So if you look at trend following and bonds and commodities, they're two of the best performing assets during inflationary regimes, but at the same time, they perform pretty well in non-inflationary regimes, which is in stark contrast to just being long commodities. So, and managed futures are predominantly trend following systems.
Yeah, I would just add that because of the cycles are so long, that you can get into a situation where an asset moves for quite some time, enabling you to capture as much of that trend as possible. And you've seen that in obviously the front end of the US yield curve, and then the dollar, and in other commodities, natural gas, for example. So these are a means of accessing a particular dynamic in the market that has some longevity.